Welcome to the deep dive. Today, we're not just looking at the numbers, we're really trying to get inside the strategy. We're getting granular. We're diving deep exclusively into the Q&A part of the CoStarGroup Q3 2025 earnings call.
Yeah, one of our listeners shared the source material because they wanted to understand really three core things: growth, that big AI investment, and how realistic are those long-term profit goals? And analysts were asking some pretty tough questions. How do you balance this incredibly fast sales growth with, well, keeping the finances in check? So our mission today is to pull out the key insights from CEO Andrew Florence and CFO Christian Loan from that Q&A.
Okay, let's unpack this.
Right. And the analysts, they knew exactly where to start. They immediately focused on booking trends, specifically how things changed from Q2 to Q3, and also Salesforce capacity. I mean, they've been hiring like crazy, so the question was, are they hitting a wall, especially this late in the year? They started with apartments.com.
Okay, apartments.com. And that has a known seasonal pattern, right? That's important context here.
Exactly. The CEO laid it out. Q2 is usually the absolute peak.
Why Q2?
Just driven by the big NAA event,
Huh?
the National Apartment Association Conference. That's when the really big property management companies tend to sign their annual deals, their subscriptions. So front loads the year.
Got it. So that makes Q2 huge. What about Q3 and Q4 then?
Yeah, they're modeled to be, relatively similar to each other, generally flatter than Q2. Q4 sometimes gets a little bit of a lift, maybe some year-end budget spending. But the really important takeaway wasn't just the seasonality, it was the underlying health. The CFO stressed that. Meaning growth is still really solid. They're still adding rooftops, more properties, and seeing positive trends across all the different sizes of apartment buildings, small ones, medium ones, the big complexes. It's all looking good.
Okay, so the underlying structural growth is there, but you mentioned things get really interesting somewhere else.
Yes. Homes.com.
Yeah.
That's where things get fascinating. Because the residential side, Homes.com, it's just not following those traditional real estate seasonal patterns. Not yet, anyway.
Not following seasonality. How so?
Well, the CEO described their sales production line, basically how sales are coming in, as very linear.
Linear. In real estate sales, that sounds unusual.
It is. They're not seeing the typical spring and summer buying frenzy followed by a winter slowdown that usually dictates ad sales in this space. He actually said the only seasonality they really notice in their sales activity is Saturday and Sunday, when people take the weekend off.
That's quite a detail. But if production is linear, how do you explain the booking numbers? Because those were anything but linear.
That's the kicker. The bookings at Homes.com, they were up 53% sequentially from Q2 to Q3.
Wait, 53%? Quarter over quarter.
53%, quarter over quarter. The CEO really emphasized that, given the scale they're at now, that kind of jump is just, it's highly unusual. It's just they've really hit on something big, massive product market fit, or just incredible sales velocity.
Wow. 53% sequential. That's not just tweaking things. That's like strapping a rocket to it.
Pretty much. But analysts weren't just looking at the shiny new object, Homes.com. They needed reassurance about the core business, too.
Right. Is this massive investment in residential sucking the life out of the established parts, like CoStar and LoopNet?
Exactly that concern. So there were questions about re-acceleration in the, let's call it the legacy business. And the CFO was pretty direct. He said CoStar core product trends are very positive. LoopNet, that's their big commercial property marketplace, and Apartments.com are performing right on track, sometimes even better than they modeled.
Hold on, though. Commercial real estate, CRE.
Yeah.
It's been a bit shaky lately, hasn't it? Especially office, maybe retail. How can the core CoStar product be accelerating if the market itself feels nervous?
That's a great point. It really boils down to their position. They provide essential information, which is kind of independent of transaction volume. Think about it. LoopNet and the main CoStar data service are subscription platforms. Even if companies aren't actively buying and selling office buildings right now, they absolutely still need accurate, up-to-the-minute data, pricing, occupancy rates, cap rates. They need that to manage the properties they already own.
So even in a slower transaction market, the need for data might actually increase as people trying to figure out what their existing assets are worth or what the trends are?
Precisely. The reacceleration suggests their data is becoming even more embedded, more indispensable, even when the market's tough. That's what gave them the confidence to actually raise their full-year guidance.
Okay, that makes a lot of sense. So the strong core business is basically the financial engine, or maybe the shield, that lets them fund this big push into residential.
That's a good way to put it.
Which brings us neatly to the tech side. That's the foundation of the residential fight, right? The AIS. Analysts really pushed on this investment. 50% of Homes.com software costs going into new AI features, like that AI smart search they keep talking about.
Yeah, that number 50%, it sounds huge, like a massive new line item on the budget. And this is where the CEO's clarification was probably the single most crucial financial point of the whole call.
Okay, so what was the clarification? Don't leave us hanging.
He made it very clear that 50% AI investment, it's an allocation of existing resources. It is not an increase in their total spending on Homes.com development.
Not an increase, so they're shuffling money around internally.
Exactly. They're taking their current development budget, their existing software teams, and basically pointing a huge chunk of them, half of them working on Homes.com, directly at AI features. So developers who might have been building out, say, other portal features are now pivoted entirely to AI.
Wow. Okay, that's a really significant strategic choice. It signals financial discipline, absolutely. But it also makes you wonder, if you shift 50% of your R&D focus, what gets left behind? What features, what bug fixes, what maintenance is getting deprioritized or even cut to make room for this AI push? That's the sort of hidden cost of saying no new spend.
That's exactly the balancing act they have to manage internally. It's a big bet, a high-risk, potentially very high-reward bet. They're banking on these AI features like the Smart Search being so transformative, so much better for users, that whatever else they might sacrifice in the short term just won't matter as much in the long run. They want to massively speed up product improvement, and they did share some data suggesting it's working.
They shared data on the AI features already. What did it show?
Yeah, some early results. The CEO mentioned that this AI Smart Search, the feature that gives you deeper answers to more natural questions, not just keywords, it resulted in users looking at 37% more listing pages in a single session.
37% more pages viewed. That's significant engagement lift.
It is. And he also said those users were 5 times more likely to come back to the site within the next week.
Yeah.
So it suggests the reallocation, that internal shift, is already driving real, measurable changes in how people use the site.
That kind of engagement boost is gold on the web today. Okay, so the tech pivot is funded by reallocation. What about the people needed to sell it all? That brings us to the sales force.
Right. The conversation shifted to the operational side. You know, the challenges of scaling up that sales team so incredibly fast. Analysts pointed out, look, you're hiring people in classes of 100 or more. That's remarkable headcount growth, as one analyst put it. How do you maintain productivity per person when you're doing that?
Yeah, that's the classic growth problem, isn't it? Speed versus efficiency.
Totally. You just can't bring in, say, 1,000 new salespeople overnight and expect them all to hit their targets on day one. The CEO was frank about it. He acknowledged that when you hire that many new people at once, your average productivity per rep is naturally going to dip for a while.
Even if total sales are still going up.
Exactly. Because you just have a much bigger percentage of your team who are still in training or just learning the ropes early in their sales cycle.
But hang on, if their main goal right now is market penetration, chasing that 53% growth, wouldn't slowing down hiring actually hurt that strategy? Does this mean maybe the quality of those huge hiring classes wasn't quite what they expected, or the training wasn't keeping up?
That's a sharp question. And their immediate plan kind of suggests they realized they might have gotten a bit ahead of their own internal systems. The CEO said they are now slowing the growth, or even temporarily capping the size of the sales force.
Capping it? Why?
So let the training and the onboarding process catch up, as he put it, to get the reps they already hired up to full speed. It seems less about the quality of the hires and more about letting the whole support system, the training programs, the managers, the sales tools, fully absorb that massive influx of people before they open the hiring floodgates again.
Okay, so it's like a strategic pause. Optimize what you have before adding more complexity. That sounds prudent, if maybe a slight tap on the brakes.
And related to that, the CFO mentioned some pricing changes.
Ah, yes. Pricing, was that significant?
He mentioned it briefly. Said they made some slight pricing adjustments during the quarter, but he stressed the overall strategy is still laser-focused on getting market share, getting agents and consumers onto the platform. It's not about aggressive price hikes right now.
Market share first, optimize price later. Got it.
That seems to be the playbook.
Okay, that leads us to the big picture, the long-term goal that really caught analyst attention, hitting 40% profitability margins in the overall residential business. And that's not just Homes.com, right? It includes their international sites like Domain and On the Market, plus the very profitable Apartments.com. 40% margin is ambitious.
It really is, especially when you think about how much money they're currently pouring into Homes.com to gain that market share. But crucially, the CEO didn't just pull that number out of thin air. He grounded it in real-world examples, global precedents.
Okay, like what?
He specifically mentions successful international real estate portals. Companies like Rightmove in the UK, Idealista over in Spain, REA Group down in Australia.
And what's the deal with those companies? What makes them relevant?
Their profit margins are just staggering. Many of them operate routinely around 50% margins. Some, he said, even reach 75%.
75%? How?
Typically, it happens once they achieve clear market dominance. They become the default place to go. And they often move beyond just selling ads to being more involved in the actual transaction process,
Yeah.
which lets them capture more value, increase their take rate.
So the 40% goal, while high, isn't unprecedented. There's a proven business model globally that shows it's achievable once you win the market and move past the heavy investment phase.
Exactly. The potential's there. Now, when an analyst pushed for a specific date, when will you hit 40% EBITDA margin? The CEO didn't give one.
Predictably, perhaps?
Yeah. He said achieving it requires, and this was his phrase, continued blocking and tackling over the next number of years. But he did say he was very happy with their progress towards those, intermediate and long-term margin goals. Just patience is needed.
Okay, so let's wrap up this deep dive into the Q&A. It really feels like we saw a company juggling a few key things at once. On one hand, these just incredible growth numbers.
That 53% sequential jump at Homes.com. It's still hard to wrap your head around.
Right. And on the other hand, a really calculated financial strategy supporting it.
The reallocation piece. That extreme focus shifting 50% of the R&D resources to AI without just throwing more money at the problem. That shows some serious discipline using efficiency to fuel the innovation.
And that strategic resource management, combined with looking at those successful global players, it makes that path to 40% margins seem, well, at least plausible. It's a long road, but there's a map. They're clearly betting that AI, that smarter user experience, is the key differentiator that gets them market dominance.
Yeah, if you zoom out, this isn't just about CoStar or real estate portals. It's kind of a case study, isn't it? How an established, profitable company can fund a really aggressive, tech-heavy expansion without terrifying shareholders with huge new spending announcements. They're using careful cost management, that reallocation, to pay for the tech they believe will give them that long-term, high-margin win.
Absolutely. And maybe that leads to the final thought for you listening today. Thinking about your own company or your own industry. Where's the opportunity for resource reallocation? Not just asking for more budget, but looking at where existing resources could be redirected to fund a really significant technological leap forward. Sometimes, maybe the biggest gains don't come from new investment, but from making smarter choices with what you already have.